All right. So, for those of you who just joined us, welcome to the Alternative Investing Club. We meet every Friday at noon, and we always strive to have a great speaker on. 49 events per year is what we're averaging over the last 5 years. And so we don't do the Friday after Thanksgiving. We don't do one Friday or so around December. But other than that, we're right here at this time. Same bat time, same bat channel. So Amanda and Matt last visited with us on, and I do need to double check this. I'm just doing this off the top of my head, but I saw it recently, April 24th, 2020. And it was right after the CARES Act had passed during the pandemic. They came in and told us all about the tax changes that were coming through due to pandemic relief and other factors. And it was a great talk. And it's available up on the internal SharePoint. And I think it's on the Alternative Investing Club's website also. But welcome back, you guys.
Thanks for having us, Daniel. It's good to be back. Looking forward to talking to everybody today and hopefully giving you guys some good nuggets.
Yeah, lots changing this year. And I'm curious to get your take on all the new changes.
Yeah.
Yeah, it's going to be an interesting year, I think, with election running up to the elections and all that good stuff. I think I don't know, if I was a betting person, I'd say there's probably going to be a decent amount of changes coming up. So
Yeah, I think President Biden just released his 2024 budget proposal, and a lot of that are of interest to real estate investors and just high income earners in general. I think the theme of it is pretty similar to before, right? Targeting higher income people in terms of tax dollars. So yeah, that's the bad news. The
Alexander
bad
says
news
that he
is
read your book.
Thank you, thank you.
Actually,
So yeah,
I have it up here on my shelf too.
Do you? Oh, okay. I'm like, we should have it here somewhere, but
he's looking up at the ceiling, like it's buried in the back and the top.
I can't find it. I've got too many books up there.
yeah. But yeah, I think a lot of this stuff, similar to before, if any of you guys follow it, last budget proposal was increasing capital gains taxes for people making over $1 million to the highest ordinary tax rate, basically taking away the benefit of long-term capital gains. And so, for high income owners, real estate investors, I think, that's always top of mind for capital gains, but also potentially changes to 1031 exchange. They're trying to take that away again, as usual. We see this come up all the time, every time there's a budget. So those are the bad news. I think the good news is, if we're a betting person based historically on, what has or hasn't changed, odds of any of these passing are probably, very slim to none.
Yeah, and that's the thing, right? So he's a lot of these proposals are the same ones he's mentioned once a year for the last 4 years.
Yeah.
So political commentary aside, not a lot has changed in the tax world in the last 4 years. But again, leading up to the elections, I think it's going to be one of the things that he's going to put on his party platform is to, try and drive votes. So wouldn't shock me if things got passed at some point in time this year, whether it may not be all of that stuff, but it might be some of it,
Yeah. We'll talk a little bit about bonus depreciation too in our presentation when we get into it.
All right, go ahead and share your screen. And I'll watch the chat room for you, so you don't have to monitor that, and I'll just judiciously interrupt you. But there are two of you, so I guess if you wanted to monitor it, you could.
It's better if you do it because we're two accountants trying to deal with technology. It doesn't work sometimes, So
yeah,
no problem.
And we'll have plenty of time. We'll have plenty of time in the Q&A section as well, because some of your questions might be answered in our presentation. It's the no. Is that the one PowerPoint slideshow? Yeah, let's do that one.
All right.
Sorry, guys.
Might see pictures of a vacation or something. I don't know.
This is probably still elementary too. Okay, can you guys see our screen?
Good to go?
Yes, we can.
Okay.
Awesome.
Awesome. So just a brief intro for any of you who didn't join us already back in 2020. My name is Amanda Han.
And I'm Matt McFarland.
And our company is called Keystone CPA, and we specialize in working with people who want to use real estate investing as a way to save on taxes. And So we are also located in California, so for those of you who are in California. However, we do have clients nationwide, because it's not uncommon for even someone living in California, to be investing in out of state as well. So probably half of our clients are actually not local to us. And the ones who are local, believe it or not, they don't want to drive. We are in Orange County and traffic is not great. And so even some of our LA County clients just basically refuse to come see us. And so we do everything by Zoom, even the local people. But yeah, I think like Daniel said, we've written a couple books on tax strategies, and you can find those on Amazon, Barnes and Nobles, or go visit Daniel at his home. You can borrow one for free.
He might rent it out to you.
Yeah, actually, seriously, if you want to borrow it, I'd be happy to do that.
Yeah, I'd say probably.
Never mind. Go buy her book. Go buy their book.
Yeah, don't listen to him. Go buy 100 copies of it. Give it to your friends.
Yeah.
Yeah, probably 85-90% of our clients are involved in real estate to some extent, whether it's kind of, working the W-2 job, investing on the side, to runs the gamut to people who are now full-time investors. They're doing fix and flips, syndications, rental properties, all kinds of good stuff. So this is kind of what we know, what we love to talk about, and we're excited to be here. So
yeah, and we are investors ourselves too. So it's good for us that we get to talk to people like you guys and kind of hear what you guys are doing in the real estate world too.
And we are married to each other, so before I drop any weird jokes, and you guys are like, "Oh, that's kind of strange." Like,
that's inappropriate. Yeah. Is Intel approving this conversation?
Right.
But I think obviously you guys are all here on your lunch break or dinner break or whatnot, so we want to be respectful of your time. Why are we here? Because taxes is one of our biggest expenses. It's actually there's a organization called taxfoundation.org. If you are a tax nerd, if you're just interested, it's a nonprofit organization, not politically affiliated. And what they do, they've been around since the 1930s. And every year they do these analysis to figure out how much do we pay in taxes. And year after year, the result has been that Americans lose more money to taxes than we do on food, clothing, and housing combined. And so up here on the screen, you'll see some of the taxes that we pay with respect to earnings and stuff. What's also not on this list are other taxes we pay, like sales tax whenever we go to Costco, gasoline tax.
When you go to Costco?
When we go to Costco, yeah.
You go to Costco.
Cigarette tax, all kinds of property tax, right, for homeowners and real estate investors. So you can see on our next slide here that, for someone making $500,000 of income, this is what you typically see left at the end of just the Fed, state, payroll, investment taxes.
Clearly, this may not be up to the Intel standards of a technical pie chart, but this is our best attempt at it. So.
Yeah, this is like an eyeball, guys. It's like an eyeball version. This is roughly how the chart should be looking based on the numbers. And earlier I was talking about how President Biden is making some proposals and stuff like that. And so really important to understand, the more income we make, the more important it is for us to save on taxes.
Yeah, there's actually there's a judge a while ago that came out with his name is Justice Learned Hand. So you guys may have heard of him. It actually is his real name, but he said there's basically there's two tax systems in the United States, right? One for the informed and one for the uninformed, and both are perfectly legal. So it's important that we want you guys to be part of the informed crowd, right? Like, use the tax code to your advantage. It's a set of incentives that the government wants to incentivize certain behavior. So they're incentivizing, people to buy real estate, incentivizing people to start businesses, all that kind of good stuff. And so really important to kind of be educated. You don't have to be CPAs yourself, but have a working knowledge of how this works and why it's important, so that you can have that important conversation with your tax advisor.
Yeah, I think it's really important to understand there's actually, this statement almost seems like there's two systems, but we know in reality, there's only one set of system, one set of law, right? It's just whether you're able to utilize it correctly or not. And I think, so New York Times came out with an article a couple of years ago that basically said, it's unfair that these individuals on the screen make a lot more money than you and I, but they pay a lot less income taxes. And so what's really interesting was Matt and I dug into the detail just to kind of see like, what does that mean? Like, what are these really unfair and very advanced strategies that these people are able to use? And how can we use some of these things? But when we dug into it further, it was really interesting is that these strategies that they're talking about is actually not secretive at all. And they are, in fact, things that we all use from a day-to-day basis as real estate investors. So what we like to call them are like the 3Ds. And the 3Ds are deductions, depreciation, and debt. Okay, so basically these three things are part of the reason what a part of those strategies that the New York Times article talked about. And when we go through today's presentation, you're going to see that these are not super secret and are things that we do all the time. And we're going to go over each of those today. So we'll start with deductions, because I think, again, the more income you make, the higher tax rate you're in, which means the more important it is for you to take a deduction. Because for federal, if you're living in federal California and you're paying the highest tax bracket, you're over 40% in tax rates. So every $100 worth of deductions, you're saving $40 in taxes, right?
Yeah, and I think with first step is really understand what you can write off. I think this is probably one of the foundational pillars of good tax planning, is to make sure you are maximizing your deductions. A lot of real estate investors obviously are very good at capturing deductions for their rental properties, like mortgage interest or property taxes or insurance, the things that are directly related to the real estate. Those don't get overlooked that often. But what does get overlooked a lot in our experience, what we see is that people are not taking full advantage of deducting some of their overhead costs of being a real estate investor, being a business owner, for various categories. Could be, professional development, education costs. You guys have, you go and joining groups and meetups and going to conferences and things like that. Those related to real estate are deductible expenses because you're furthering your business. You're using that education to kind of generate hopefully better revenue, save expense, cut expenses, all that kind of good stuff.
Yeah. Business meals. We get a question a lot, like business meals. Does it have to include somebody else? Is it just myself only, me and my spouse? So it really depends.
Just has to include your CPA. That's it.
It really depends. So if you are having a business meal with, let's say, another coworker, you guys are going to invest together, and you are discussing business, then generally that could be a business expense. If you are traveling, right? If you're traveling to a real estate conference, you're traveling to look at a property, work on a property, then even though the meal might be by yourself, it's still a business deduction because you were there for business purposes. With respect to eating with your spouse, I think the one thing I always tell people is like, the common thing I hear people say, oh, me and my spouse, we talk all the time about real estate or about our business. Can we write off every single meal? Unfortunately, the answer is no. You cannot write off every single meal just because you happen to talk about real estate or think about real estate. So with your spouse, you just want to be careful. You want to make sure you're able to document predetermined business activities. So I don't know, maybe once a quarter, you guys go out to a nice dinner where you have pre-planned that you're going to be discussing certain items, right? So that's a lot more impactful and legitimate than let's write off our Subway sandwich every single day.
I have a quick question that relates to that here from Naranja. He's asking, if we're a passive investor, can we still write off our meal?
Yeah, that's a great question. And I think a lot of you guys on here are probably passive investors with respect to real estate if you're still working on a full-time job. And there is no difference between what you can write off in terms of active investor or passive investor. Okay, so we can all write off the same things. We can all take depreciation. We can all do cost segregation. The limitation and the difference is only going to be if we have a net loss after writing everything off and depreciating what we can, what happens to that loss? When and how can we use it? And we're going to cover that a little bit later on. But just so you guys know, what can I write off? What can I depreciate? That is the same for every single person, regardless of whether you're a real estate professional or not.
A couple of other things that come to mind in terms of like overhead costs of being an investor, home office expenses. I know a lot of people are, manage and run their real estate from their house. A lot of people aren't going out and renting office space to quote unquote manage their real estate, right? I mean, I think there was an article that came out couple of years ago, it was like 50% of Americans have some kind of home-based business nowadays. So if you have a dedicated space in your house or you're using for office, don't be afraid to take the home office deduction, because what it does is it can convert percentage of your expenses you're paying for a house that you don't usually get the deduct. So outside of mortgages, property tax, the other stuff, takes a percentage of that other stuff and makes a tax deduction out of it. So it can add up to a couple $1,000s in deductions very easily.
Yeah, I think for those of you in California and other like just high state income tax places where we're really limited in terms of like our primary home property taxes, and state income tax, we're limited to that $10,000. Well, the home office deduction is sort of a loophole around that, because there is no limit on the home office with respect to property taxes, right? So it's something important to understand. And of course, car expenses, if you're driving your car for your real estate, the business related portion is tax deductible. So make sure you're capturing all of that. And when we talk about business miles, it's not just driving to and from a property. It's basically driving for anything you're doing with respect to real estate. So even if you have only out of state properties, but you're going to a local real estate meetup, those miles are deductible. Right? Driving to meet with your CPA, driving to meet with your attorney, because of real estate, those are all deductible miles as well. So really important to make sure that we are tracking all those expenses, because even if you're passive, even if it's not helping to reduce your W-2 income taxes immediately, there is a future benefit that you will get at some point down the road. Okay.
I think another great opportunity area for utilizing tax strategy is just with respect to kids. So we have two kids. We know they're expensive. One of them is becoming a teenager. Acts like a teenager. Well, he acts like a teenager already, right? Like, so we know it's expensive, and so a lot of times people ask the questions like, well, can I take a deduction for the money I give to my kids? And it's like, you ask 99 out of 100 CPAs, most of them are going to say no. But the right way to do that is to have your kids help you in your real estate business. Hire them just like you would for any other person. You're paying them just like you would for any other employee that you hired. As a family, you can take a tax deduction for it. It's going to save you whatever tax bracket you have. And again, maybe now, maybe later, it's going to save you, but at some point, it's going to save you, right? And then on the flip side, your kids, most individuals can make about $13,000 a year in income right now and not have to pay income taxes on it. So again, if you are saving, you pay your kids $10,000 across a couple kids, saves you, your 40% bracket saves you $4,000. Kids don't pay anything, 0%. As a family, you've saved on money that we all know you're already giving the kids. So now let's find a way to give it to them in the business. Then they can use that money to go out and pay for whatever they want to pay for, that teenagers want to pay for these days.
I'm sure we'll get a lot of questions about income shifting, so we'll save those for the Q&A part. Can I get a pen? But I think one of the things that's really important, for those of you who haven't already filed last year's tax returns, one thing that you could still do to save on last year's taxes is to make sure you capture all of your legitimate expenses. And a good exercise or something to practice yourself is, instead of asking your tax person if you can write something off, ask how can you write something off. And I would pose this question to things that you're spending a lot of money on, like kids. And so, because what that does, and it helps you and your tax accountant be in a more creative mode to think about, okay, well, normally you can't write off your kids, but how can we, if they can help, if they can do this. Normally I can't write off this trip, but how can it become a tax write-off? Because then you can be more strategic and think ahead. Maybe there's things that you haven't thought about yet. And so on this next slide, we just shared a couple funny things that the IRS said taxpayers were not able to deduct, but according to them, taxpayers fought in tax court. And these are some of the deductions that ultimately was allowed by tax court.
Yeah, I think there's a few on here that are real estate investors, if I remember correctly. So I think the private client was a real estate investor. The girlfriend was a real estate investor, actually. It was a property owner that was having his girlfriend help him manage his properties, paying her to do so. And so the IRS said, come on, you're just giving your girlfriend money. But took them to court, had all the documentation, was able to show that, no, she was in fact working for me and I paid her legitimately, did all the stuff I was supposed to do. So now obviously you guys aren't going to have all these, you're not going to, maybe some of you are going to have wigs, I don't know. But the key here is, again, to think about kind of change the frame of mind and how you're asking the question and how you're thinking about tax deductions. Is there something that you're spending money on that is ordinary and necessary for your business? And if the answer is yes, you can make an argument that the answer is yes, and that should be a tax deductible expense that'll help you now or help you in the future, right?
Yeah, and if you don't know the answer, that's what your tax advisor is for, right? You call them up or email them beforehand and say, hey, I'm about to spend money on this. Is it a deduction? How can it be a deduction? What should I pay it from? Should I pay it from my LLC bank account? Should I pay for it from my, personal bank account? And then that's how you make sure you capture everything. Speaking of LLCs, one important thing just to mention for those of you who have not heard this before, legal entities are not required when we talk about tax write-offs. So all of the things we talked about so far, education, travel, meals, car, home office, paying your kids, none of those require you to have a legal entity. Now, we're not saying don't have an entity, right? If you probably have a lot of assets that you want to protect from your rental property. So it's absolutely important to have legal entities from a liability protection perspective. But this is just to say, even if you don't have legal entities, you can still take the same deductions nonetheless. Because what the IRS looks at is whether an expense is necessary and ordinary with respect to your real estate business. They don't really care whether you have an LLC or not. Conversely, if you have an LLC and you start paying for your spa treatments or getting your nails done, that doesn't mean it's going to be a business deduction just because you paid from an LLC. Okay, so we want to make sure we're doing things correctly.
So we've kind of covered, if you recall, we covered that the first D in those 3 Ds, right? We talked about deductions. Now we're going to kind of talk about depreciation, because depreciation is probably one of our favorite topics from a tax planning perspective with respect to real estate. I like to refer to it as like the 9th wonder of the world. I think I might be the only one who refers to it as that, but in essence, with from a tax planning perspective, think about it. You're going out and buying rental properties. You've got, hopefully your properties are cash flow positive. But then what the IRS allows you to do is, under the premise that your property is going to have normal wear and tear, they allow you to write off a part of your building every year. It's almost like a paper loss. It's paper loss because you're not spending money every year to get this depreciation expense. So in a perfect world, you've got cash flow positive, but with enough depreciation at the very least to wipe that out, get that down to zero, so you're not having to pay any income taxes right now on your cash flow. In a kind of supercharged world, maybe you've got more depreciation than you do cash flow, might create a loss. Then as Amanda was mentioning earlier, is there a way that we can use that loss to offset other income? And we'll kind of get into that. But that's the power of depreciation. It's a way to shelter income from taxes currently. Don't get this with other investments, right? You go out and buy stock. We're not writing off the cost of stock right now. You don't get to write that off until you actually sell it down the road. That's why we like real estate.
Yeah. So we'll go over some examples about how powerful debt is in helping to build wealth and also save on taxes. So let's say you had, $100,000 to invest, right? We have a couple different options. One is we can use all of that to buy a property all cash. And if we did that, let's say $100,000 building, if we do cost segregation, accelerating our depreciation, we might get $20,000 in depreciation, which is great because that means that the first $20,000 of rental income that I earned this year, I'm not going to have to pay taxes on it, right? Or I can, use leverage. So let's say my $100,000 is now a down payment on a $500,000 piece of real estate, or $500,000 worth of real estate, right? And so in that scenario, I might get $125,000 of depreciation. So you can see there's a huge difference because now I'm involving leverage to really create a much higher depreciation in terms of tax savings, right? And then if we can just use another example, and let's say, yeah, I'm just going to keep my $100,000. I'm not going to use any of it. I'm going to use creative financing or seller financing. I'm going to buy this $500,000 property with no money down. Well, guess what? My tax benefit depreciation is still going to be the same at $125,000, right? And so this is where you can see. This is what the New York Times article talked about a lot. Is like, hey, these people, they're able to just like borrow money, not pay any taxes on it, use it to buy businesses and real estate and get depreciation. Well, I mean, that's really what the law allows any of us to do, not just super wealthy people. And in fact, for those of you who already invest in real estate, you probably already know this. Whenever you build up equity, you can refinance and do a cash out refi, and you don't pay taxes on that money currently. right? So not only do you get to access more money with no tax, but you also get more deductions because now you have interest expense that you can write off against all of your rental properties too.
Yeah, now the true thing about that article is those people they were talking about, they may have a lot more zeros after their numbers than we do, right? But the strategies are all the same. You can utilize all the same strategies those people can do.
Yeah. So let's go to the question about passive losses, right? Because that was brought up earlier in terms of like deductions. And so it's really important to understand that regardless of whether you're active or passive, we have the same deductions, we can take the same depreciation. And then after we do that, what happens when we have an excess loss? Well, the good thing is you don't ever lose out on that loss. If you're a passive investor, your losses can be carried forward indefinitely into future years to offset passive income that you may generate.
Yeah, and that can be powerful. I mean, that could be, you could be, have some losses. Even if you can't use them now, they carry forward to future year. You can use them when you have positive income from that rental or other rentals in the future. Maybe you sell that property and then it allows you to use some of that loss. So different ways to do it. But in the tax world, the general kind of rule is that rental real estate is passive by nature. Now, if you happen to make, you and your spouse happen to make $100,000 or less, the IRS does allow you to deduct up to $25,000 of rental losses against your other income. So if you were making $100,000, $25,000 loss on rental real estate, I mean, that's going to move the needle a lot with respect to your income because that'll wipe out 25% of your income right there.
Yeah. But if you make over $150,000, generally long-term rental losses are passive, which means, they offset other passive income you have now and in the future, unless if you or your spouse is a real estate professional. So if you are married to someone who is a real estate professional, then your rental losses is now freed up to offset different types of income. So like a common profile we see is maybe somebody working at Intel, they have a spouse who doesn't have a job and just sort of does real estate or deals with the rentals full time.
Well, they're trying to find a spouse who does that full time.
Yes,
that could also be
matchmaking.
Yes.
And so what happens then is now your rental losses are no longer passive and it can be used to offset all types of income, including W-2 income. So that's sort of like an ideal profile of where you're able to kind of use losses from one bucket into the other bucket. So, we keep talking about how passive losses are not limited because don't expire, because we always hear people tell us that, hey, my old CPA said don't claim home office, don't write this off because you're not going to get a benefit anyway. So again, you might not see a benefit today, but you will get a benefit in the future because you have to claim those deductions and losses to be able to carry it forward into the future year after year, right? But I think the reality is not everybody is a real estate professional or can be married or wants to be married to a real estate professional. And that's where the short-term rental tax loophole comes in. It's a really, really powerful strategy for any of you who are interested or currently investing in short-term rentals, because it's a phenomenal way for you to be able to offset taxes from your W-2 income using rental real estate.
Yeah, no, so take a step back. So real estate professional deals with people who are investing in long-term rentals. So the workaround again is if you are somebody who is looking at investing in short-term rentals, the ability and threshold to meet in order to use rental losses from those short-term rentals to offset other income, it's a lot easier with short-term rentals than long-term rentals. So what is a short-term rental for tax purposes? It's just where the average customer stay during the year is 7 days or less. So 7 days or less, we've got a short-term rental. 8 days or more, you have a long-term rental. Doesn't mean that just because you put on Airbnb or Vrbo that it's a short-term rental. You do need to look at the average customer stay during the year. But again, if you have a short-term rental and you can meet what they call one of the material participation requirements, then if you're able to strategically generate losses from your rentals through maximizing depreciation, you can use those losses to offset W-2 or other income you have on your return. So this can be very powerful, especially again for people that maybe it's two spouses that are working full time and they just don't, they're not going to be able to do full-time real estate professional for long-term rentals. But if they self-manage one or two of their own short-term rentals and meet the requirements, then it's an easy way for them to utilize rental losses to offset their rent income, like we were talking about.
Yeah, we'll go over an example with real numbers from a client of ours just to kind of demonstrate the power of what can be done against W-2 income for short-term rentals. But just real briefly, we wanted to kind of go back to, for those of you investing in long-term rentals, right? The question we get a lot is like, what type of income can, passive losses actually offset? So I think Matt touched on some of them, right? Other rental income, so losses on one property offsets income from another. Gain on sale of rentals. So when you sell a rental property and there's capital gains, you may not need to do a 1031 exchange if you have enough passive losses because they do offset those. If you've invested in other passive activities, if we're talking real estate, you might be talking about, real estate syndications and things like that. So there's a lot of other different things that you can offset. If you invested in an apartment syndication or something and it sells, your own rental losses absolutely can offset all of those too.
We have some another clients that I'm thinking of. We have a lot of medical service providers, doctors, nurses, various people in the medical field. But we'll see that sometimes where they've gone out and invested in maybe a surgery center or a dialysis center where they might be working there once or twice a month, but they're not running that business. They're not making decisions for it. So, but that business is profitable. So they get a K1 at the end of the year that shows, hey, your share of the profit was, whatever, $75,000. That's going to be passive profit to them, passive income to them. So if they have rental losses from their own properties or other passive investments, they can use those to offset that income from that surgery center in my example. So that's a powerful way if if you or maybe your spouse falls in that category that you can strategically use rental losses to offset passive income.
Yeah. I mean, you guys, I don't know how many of you guys are investing in surgery centers and working there part-time outside of Intel, but
maybe your spouses or your future spouses.
Extrapolate that into your world. Maybe you got a cousin or a friend who has a startup business, a restaurant or whatever, right? You're investing in that gives off cash flow. If you're not working in that restaurant, if you're not working in that tech company, then those could be passive income to you and you can use your rental losses against it. Okay.
Hey, Amanda, just a heads up, we have a ton of questions. So I don't know how much longer your presentation is going, but we can take the rest of the time with questions.
Yeah,
that's fine.
I'll try to prioritize some of them. And
yeah, that's fine.
Rather than reading them off, I'm going to ask the person who typed in the question if they would just ask it personally, take themselves off audio and do that. So it's a little more interactive.
Yeah, for sure. We can do that. So on the real estate, on the retirement account part, I just want to touch on, you guys probably already had self-directed custodians come to speak about it, but really important, a question we get a lot from our clients is like, hey, I would love to fund my 401k and IRA and all that stuff, but I'd rather use it in real estate. So just make sure you understand that you can actually do both. You can fund a retirement account, get a tax deduction, and then that money at some point, or maybe even now, could be rolled over to a self-directed account, and you can use that for real estate investment. Okay, so our last slide, let's go real quick. This is an example of a couple who never owned any real estate, started investing in short-term rentals in California. They bought two very small single-family homes in Big Bear, California. So you can see on the screen, let's raw all the numbers since we're short on time. W-2 income, rental income, a little bit of income shifting because they had really young kids, not too much to deduct. Just track their existing car and home office. Depreciation deduction on that first year with two single family homes. You can see how much write-off they got from there. So you can see
obviously they did a cost segregation study, right, to accelerate as much and take advantage of bonus depreciation and all that good stuff.
Yeah, so you can see this is, again, two people who are working full-time and just one short-term rental. That was what they were, two short-term rentals. That's what they were able to get. So, one of the things is just making sure you understand that tax savings comes from planning. Okay, when you're filing your tax returns now for last year, you are not doing planning, you are not being strategic. And so ask yourself, what is my tax savings plan? If you can answer that question, then that's amazing. You're ahead of most people that we meet. And if you don't know the answer, if you can't answer this question to yourself, what is my tax savings plan? Then you should find someone who can help you with that. It could be your current CPA. I would definitely set up a separate meeting with them. Don't try to rush them with questions when they're filing taxes for last year. Set aside a dedicated time outside of tax preparation to go through what your questions are. If any of the stuff we talked about is new to you, use the QR code to go to our website, or you could just go to our website at KeystoneCPA.com. You can download our free tax savings toolkit at any time. We talk a lot more about the short-term rental loophole, how to pay our kids, and all that good stuff. But no worry, Daniel, this is typically common for us. We usually have a lot more questions than we can answer, which is why we should probably do like an 8-hour tax event at some point.
I could be up for that, to be honest. I would go for that. I'd probably bring a few more people in, maybe, but that actually sounds fun.
Yeah.
Okay, so I think what I'm going to do here is I'm going to call on names, and if you could just unmute yourself and make the question quick, and also to Amanda and Matt, we're probably going to have to make it quick. We've got quite a few here, but take your time as well. So going over to TK Shaw. Also, my apologies. Usually we've been averaging 70 to 80 people. My Zoom limit is 100 people, and we've capped it out. So if there's anybody here who had a hard time getting on, my apologies.
Yeah. So I have a quick question for the home office. What business qualify for home office, and is there any limit how much we can deduct from the state or federal, or where can I find more information on that? Thank you.
So regarding the home office deduction, I think the question was what kind of business qualifies? Did I hear it correctly, or?
Yeah, that's correct. Is there any qualification criteria for that?
Yeah, the main criteria doesn't necessarily have to do with the business per se. It just means that you are kind of one of the primary places of running your business is your home, and that you have a dedicated space at your house. So the easiest way to look at it is, do you have a separate room that is an office space that you're not using for a bedroom, you're not using for anything else, and you're running a real estate business, you're running, I don't know, you're selling things on Amazon, whatever it is. As long as that's a primary place of kind of managing and running your business, then that should qualify for the home office deduction. There's not really a limit per se. It's all dependent upon square footage and how much your expenses are to kind of do your house and things like that. But
okay, I'm going to go to Mike Zatra.
So my question, can I do accelerated depreciation after 3 years of house rental investment?
Yeah, for sure. Cost segregation can be done anytime during your ownership of a property. It does not have to be the first year or the second year or the third year. But before you do a cost segregation, you want to make sure that you can use it, right? You want to make sure it is the right move for you. So the first step is to talk to your tax person and say, hey, does it make sense for me to do a cost segregation? If the answer is yes, then yes, you can absolutely do it anytime during ownership.
Thank you.
Yeah.
Okay, next, Thomas Hart. And after that, we'll do Alexander.
So my question is, I have a second home that I bought last year, and I've Airbnb'd it out, but it isn't rented out often enough to make a profit. I just make some money. So I'm wondering what can I deduct the mortgage interest and do the depreciation schedule as normal? What's my best options in that case?
I'm going to make some assumptions here, but typically, like on a second home, if you do rent it for less than 14 days during the year, you don't actually have to report the rental income. And then you might be able to deduct the interest and the property taxes as kind of a second home, depending on what else is going on in your return. If you did happen to rent it for more than 14 days, then it's going to kind of be, probably like a rental property in your return where you would have to prorate the expenses between personal and rental use. you can still depreciate the property to the extent it was, a rental property. So there's a couple different options, but it would something to sit down with your tax person about for sure.
Okay, thank you.
Okay, Alexander, I just typed in the chat to you, but his question was, is it super difficult to get real estate professional status if you have a W-2 job?
Yes.
I'm sorry, I took it from you.
Super difficult. Yeah, it's super difficult because, so let's talk real quick about real estate professional. And you guys can go to KeystoneCPA.com and download our tax savings toolkit. We talk a lot about what the rules are. Big picture, at least 750 hours in rental real estate. Second one, which is the killer, more time in real estate than your job. So this means if you work 2,000 hours as a full-time W-2, you got to have more than 2,000 hours in real estate, which makes it difficult for people. And then the third one is material participation, which means at least 500 of those hours should be more hands-on management type of stuff that are related to your rental real estate. So that's why it's very difficult.
So that's why you see, like, if we're talking about the situations where one spouse may be working full-time, the other one might be working part-time, that part-time person might be the one who can try and qualify for real estate professional. If they're only working 700 hours in a regular job and they can work 750 in real estate, they might be able to qualify.
So my short-term rentals in Idaho, 7 hours away, I can't count the driving time.
You could count the driving time. You could count the driving, assuming you're going there to work on the property, right? So if you're going there to work on the property, your driving time is part of real estate professional time. However, you still have to have more hours than that in real estate than all of your other jobs combined.
Oh, he's talking about short-term rental.
Oh, well, sorry, you're talking about short-term rentals. Sorry. So for short-term rentals, it depends. So short-term rentals, we don't care about real estate professional. We only care about material participation. So whether your driving time counts depends on whether the stuff you're doing there is material participation work.
Okay, let's go to German. Ham.
Yeah, hey, thanks. So maybe you've already answered this question, so I apologize. Using a vacation home as a short-term rental is the context of the question. So the question is, what's my minimum rental period to be able to claim short-term rental benefits?
Technically speaking, it needs to be one day. Now, I don't know if I recommend that necessarily, but think of it from the perspective of how do I show that the average customer stay was 7 days or less? Well, you have to have at least one person staying there for at least 1 day.
Yeah.
I'd recommend more than that, obviously, but that's the technicalities of it. And you also need to be, I think there was a question. One of the questions earlier was like, hey, I rented it out, but it wasn't rented out all the time. Well, as long as you can show that you are attempting to rent it out, you put on an Airbnb, you put on Vrbo, and maybe just didn't get enough, bites on the apple or whatever. It still can be reported as a short-term rental, again, assuming the average stay was 7 days or less.
And I will say, because I don't know, German, if your question stems from like, it's my vacation home, I vacation there all the time and rent it out for 1 day, that's not going to work. If you're using this strategy in its true sense, you have very limited personal use. Yeah. So that would be a scenario where you personally use it 1 day, because your personal use has to be less than 10% of business use, looking at days. So 300 days rental, 30 days personal is the max you can have personal use.
Right. Thank you.
Okay,
yeah.
Navid, Taj, Jadad.
Yeah, I think you already answered my question, but I have another question. Let's say we have a house and we rent out the basement as a short-term rental. Can we do accelerated depreciation on that part or entire house or not?
So you could do the short-term rental loophole, but it would be on the portion of the basement. And this also assumes that the basement has its own entrance and all that stuff, right? Like almost like a separate unit. That's not just like a room in your house. But yeah, we have a lot of clients who use this strategy pretty successfully, because when it's an ADU or a basement and all that, you're on site. So odds are you're doing the management, you're doing the cleaning. So it's much easier to meet the hours. So it could work, depends on how you set it up. We also have clients who restructure their home just to be able to do that, where they put in a separate entrance and all that. So yeah, we're thinking about if that kind of fits what your model is. Yeah, I think we're hearing a lot of short-term rental related strategies, right? Questions, not surprisingly. Again, go to KeystoneCPA.com. In our tax savings toolkit, we have like a 30-page thing just about the short-term rental loophole that will answer a lot of these questions I'm seeing on the chat.
There was one question that was right up at the top that said, do you only have a SoCal location? For some reason, I assumed you were in Colorado since you were named Keystone. Do you have more than one location that you operate
people
out of?
think we're in Pennsylvania too, like Pennsylvania, because Keystone.
Yeah, our office is in Southern California, but we do work with investors all over the country. So
yeah, we don't have other office. I mean, we have, remote workers as well, but in terms of like physical office, we're in California, but we file tax returns in all 50 states because we have clients who just invest everywhere, like it or not.
All right. Apologies for the name, but either Ein or Ann, you've got a fairly detailed question.
Yeah, Ein here.
Ein.
So my wife is a real estate professional now, homemaker, and picked up that status this past year. And we have 2 properties in Idaho, and she traveled in 2023 for about $12,000 worth of travel expenses out of state, out of country to find our third property. We finally purchased our third property in early 2024. Since we didn't have that property in 2023, how can we deduct and account for the expenses in 2023 for the, how can we deduct those expenses since we didn't have the house in 2023?
And we did have other rentals in 2023.
We had 2 other rental homes in 2023, but not this one. And, the expenses were, of course, house finding expenses. And yeah.
I feel like it kind of depends on your risk tolerance level. If we're talking about like a larger amount like that, if it's like a smaller amount, we usually just deduct it. It's part of overhead rental related, right? I have my portfolio, I'm trying to grow it. So normally we just deduct it as overhead cost against
maybe I'll say right now I have
properties.
Right now I have reported it as our self-employment loss, but there is no profit, so it's like, is it better to put it in?
I would not do that.
Yeah, it shouldn't be self-employment loss would be on a Schedule C. You're gonna want to put this on a Schedule E with your rental income.
Yeah, because this is rental related, right? It's not a separate non-real estate business, so it would be on Schedule E if you're going to be deducting it.
Okay, so Schedule E is better than Schedule C for this one.
Well, yeah, because that's the correct way, right? It's rental real estate related. And also, if you just don't want to have a Schedule C large loss with no income, that just always looks very fishy to the IRS. Like, what's going on here?
Got it. Okay, thank you.
Yeah.
I'm going to be selfish here and interject my own question. What do you guys think the chances are of getting our 100% bonus depreciation deduction back? It just passed the House. You think it's likely to pass all the way?
It's so funny. I don't know why we missed it on our slide. That's why we didn't talk about it. Yeah, I must have deleted by accident, or maybe we hopped over it. So yeah, 100% bonus depreciation. So current rule is 2023, we have 80% bonus depreciation. 2024, we have 2024, we have 60%. The law that's going through Congress, already passed by the House, yet to be passed by the Senate, is to bring back 100% bonus depreciation to 2024 and 2025 and retroactively for 2023. So, the one we were just talking to, if you're doing real estate professional, maybe wait to file 2023 tax returns, because if it gets passed retroactively, then you'll be able to use 100% bonus, on your 2023 tax return. So I think the question is, what do we think if it's going to pass? I don't know.
I would think it is. But it's interesting that they started talking about it and brought it up as a proposal or bill after 2023 was already passed. Like the tax season already started. It's like, oh, let's do this. Let's change taxes for last year. And it's like, You guys
Yeah.
obviously have no idea how this works, but
Yeah, I was really hopeful. So I think it passed the House in February,
a
like
while ago, yeah.
yeah,
Couple
early
weeks.
February it passed. I was super excited. I posted all over social media, and then I think I just jinxed it. And everybody was asking me like, what happened? What's going on? And now I'm just kind of like, I don't know what's gonna happen. The IRS did say, just so you guys know, for those of you who don't want to file extensions, the IRS did say that if you have to file a return and they pass it after you've already filed, then they will amend or they will recalculate your taxes and issue you a refund.
All right, and if you believe that, then I've got some property to sell you.
I think they will try to do that, but it's going to be very difficult, you know.
Right.
They
A lot
also
of
like to
barriers.
send you
years from
threatening
now, too.
letters. All right. Do you guys get that a lot with your clients where the IRS will send them fees and letters and then you just file a form and they waive it? That seems to happen to me quite often.
Mhm.
There's times where you can do that. There's times where you can kind of it's called basically like the first time penalty waiver. But if you're somebody that's utilized that already, unfortunately, the next time you're gonna have some real reason for
Yeah, some
getting-
other excuse as to
another
why.
excuse, a real reason for getting the penalties waived. But yeah, they've been that's one of the things with the budget that came out last year, 2 years ago. The IRS is getting a lot more money given to them for improving the computers and hiring more auditors and things like that. So it's not going to be probably out of the realm of possibility that people will start getting a lot more IRS notices in the coming years.
Okay. Ashish.
Yeah, thanks you guys for coming in. Accelerated depreciation is great, but I don't really want to buy a new house every year, or have to recapture it at the end when I sell it. I just wondering, have you guys come across any tax savings that provide savings every single year after year? Like, what are the best ones you found?
I mean, well, it's so different, right? Because our specialty is in real estate. So typically, if our clients, the profile is that they do want to buy a property every year or every other year. And the goal is to ultimately end up with a portfolio of properties to pass it off to the kids and grandkids, and nobody pays the tax, right? Because of step-up basis. If your question is non-real estate, like what other assets generate year after year write-off with just one-time investment, I really can't think of any. I can't think of any where it's like I invest $100,000 and I write off $100,000 every single year. I wish there was something magical like that, but no. I think the closest thing that we come to that's similar to real estate, but also more of a one-time or somewhat couple year write-off is oil and gas. I think Daniel said you guys had people come talk about oil and gas already. We had people who invest in like conservation easements. I don't know if Daniel, you guys have people come talk about it. It's not something we recommend because it is on the IRS's dirty dozen list. They don't really like that at all. But other than that, I don't know. I can't really think of any that's like year after year savings, unfortunately. But if you find one, let us know.
All right. I will open it up then. If you have a question, go ahead and speak. And we have 3 minutes left.
I have one question, Daniel.
Go ahead.
I have a question.
Yes,
So
SM.
this is regarding a depreciation. So let us say I have a property which is doing a negative cash flow. But I have other properties. So can I still take the benefit of a depreciation on the negative cash flow property?
Yeah, so depreciation, interestingly enough, is something on a rental property you're actually the IRS expects you to take it every year. So if you have a negative cash flow property, you would still add depreciation to your return. It would create a bigger loss for that rental. And if you have other rentals that have positive income, you can use that loss to offset that other income from the other rentals.
So if I don't have the positive cash flow overall, can I that deduction, can I take it from the W2 income?
It's going to depend on what type of property it is, short-term, long-term, whether you make real estate
long-term
professional, how
rentals.
much income you make.
Long-term rentals.
Do you qualify as real estate professional?
No.
Okay, so if you don't qualify as real estate professional, your rental is already in a loss. What you should do is just take regular depreciation, because that is a requirement. You have to take depreciation, right? You'll just create a bigger loss, which you'll carry forward. At some point, that loss will offset your rental income, or when you sell the rental, it'll offset your W-2 income. But you will not want to do accelerated depreciation because you're not going to get a benefit right now.
So the regular depreciation, I can do it, and if there's a loss, I can carry forward it.
Yeah, you have to do it like Matt said. It's a requirement. You're required to take depreciation. It's not a choice.
Oh, okay. Okay, thank you.
Yeah.
Really quickly, is there a limit to the amount of depreciation you can take? Sorry, an
it's
income
limited
limit.
based on. There's no income limit. It's based on, the starting point is that what you pay for the property. So I guess that would be your big picture limit. But
I mean, there is
there's calculations and ways they do it, obviously. But
yeah, I mean, there is a limitation, just for those of you who are higher income earners, for rental loss. If you're a real estate professional or using the short-term rental loophole, there is a limit against W-2 income, about $600,000. So that is something that's newer in the last couple of years that sometimes catches people by surprise.
All right, Glenn, you've got the last question.
Oh, hey, thanks. So you mentioned, and thanks, by the way, for coming in. This is great. It's always a popular topic. So you mentioned earlier, about effectively carry forward losses and so forth if you can't claim it as offset to your W-2 for us employees. What typically is, the most common model in which you see how that works itself out at an exit event or a cash event or something like that? That's where all of this sort of pent up losses or whatever are going to take the offset against the income or the profits at that point?
I think it's different for every property and every investor. One of the stories Matt shared was like, hey, if you happen to invest in other passive things like a friend's business or something like that, then you might be able to use it immediately. You don't have to wait, right? Because passive losses always offset passive income. But other than that, once you get to a point where your portfolio is positive taxable income, then you'll be using it, because I've already, it's all stabilized and my cash flow is better and better, then I start using that immediately too. But in terms of offsetting against W-2 income, yeah, it's usually that passive loss is going to be freed up when you sell your rental real estate. So if I sell, there's going to be a gain. I can use it to offset the gain. And if there's still more losses, I can use it to offset my W-2 income, even though I'm not a real estate professional. So that's why I was saying, don't fall into this trap that you don't get a benefit, because you will. At some point you're gonna benefit from it.
So a sale event, sorry for the follow-up, and I know we're running over. So the follow-up is, if I have a sale event, I can then offset my active income.
Yeah, so let's say you've accumulated some passive losses over the years for a particular property. You sell it in year 5. Maybe the sales price, minus your basis, maybe it's a zero gain, just to keep it simple. But you've got $50,000 of losses carried forward. Those $50,000, because you're selling the property in a taxable event, like not an exchange, those $50,000 losses would be released and allowed to be deducted against your other income in the year of the sale.
Like W-2.
Yeah.
Okay.
And a lot of people don't know this, right? They treat, and even CPAs, they treat them like stock sale. So then it's like the tax, the investors using $3,000 per year. So we see that error a lot because they don't know that it's actually just an ordinary loss.
So on behalf of everyone else, take yourselves off mute. Say thank you for coming in. I'll save Daniel the trouble. Thank you so much.
Thank you.
Why don't we have everybody take themselves off mute and thank Amanda and Matt.
Thank you.
Thank you.
Thanks, Ben and Matt.
Thank you.
Thank you.
Thank you.
I didn't hear that fifth person. What did they say?
Thank you.
Yeah, my question was, how can you take a passive?
Oh, I was just going to say, guys,
W-2?
today is March 15th, which is, guys, we should have mentioned that. Today's March 15th. For those of you with entities, if you have a corporation, on the side, a partnership, an LLC with multiple members, today is the deadline. So if you haven't already, make sure you file extensions or call your CPA right away. They might yell at you, but you got to do it today. Today is the deadline for extensions.
I was honestly amazed you booked
Daniel.
this particular date. Manju, is that you?
Yeah. Just a quick question.
We're going to go over with one quick question.
But what I keep hearing from CPAs is you cannot offset your passive loss with a W-2 income.
Mhm. Yeah, I think we just answered that question, right, in the earlier.
Yeah, you saying that you can offset your W-2 income with a passive loss, but okay, that was a news to me.
Yeah, you can do that when you're a real estate professional, or if you're using the short-term rental loophole, or when you sell the property, right? Those are three common scenarios of when you can use it.
Oh, but it's not like an and condition. It's or like you have to or condition. Oh, okay.
Yeah.
Okay. Yeah.
All
Thanks
right,
a lot.
we gotta let them go. Okay.
Yeah. Thanks,
Thank
Daniel.
Thank you very much. Thank you very much, Amanda. Matt, it's always great to see you in here.
Thanks, Daniel. Appreciate it. Good to see you too.
Bye, guys.
Yeah, thank you. Bye-bye.
Bye, guys.